Welcome to the deep dive. Today we're taking just one source. It's a detailed investment analysis memo about Zoetis, and we're really going to unpack it.
Yeah, the plan is to stick strictly to this document.
Right. Our mission is simple. Pull out the core insights, understand the business, its strengths, weaknesses, all based purely on what's in this analysis. Cut through the noise,
Get straight to the important stuff.
Yep.
And the company is Zoetis, a big name, obviously, in animal health. We're seeing what this particular analysis tells us.
Okay, let's dive in. First up, the basics. What does Zoetis actually do?
Well, the memo lays it out pretty clearly. They discover, develop, manufacture, and sell animal health products and services. So medicines, vaccines, diagnostics, the whole range.
It mentions something like 300 product lines. That's quite a lot.
It is. And they split it into two main divisions. You've got companion animals, dogs, cats, horses.
Okay.
And then livestock, so cattle, swine, poultry, fish, sheep.
Now, here's something interesting. The analysis highlights a big shift in their business mix.
Yeah, this seems crucial. Back in 2021, companion animals were about 60% of revenue?
Right. And by 2024, this memo says it jumped to 68%, so livestock is down to 31%. It's tilting heavily towards pets.
Geographically, though, it's still pretty balanced, like 55% U.S., 44% international.
Yeah, roughly that split. But what's really fascinating, according to this analysis, is how simple and durable the underlying business model seems to be.
It's rooted in these two really enduring human trends. Right?
Exactly. First one, the human-animal bond. The humanization of pets, as they call it.
We see that everywhere, don't we? People treating pets like family members.
Totally. And the memo points to a 2020 study found most owners wouldn't cut pet spending much, even if their own budget fell by 20%. That emotional connection is powerful.
Powerful for spending, definitely. People are willing to pay for premium health care. And this analysis projects the companion animal market to grow at, over 9% a year through 2034.
9.34% CAGR. Pretty healthy clip.
Okay, and the second trend.
Rising global demand for protein. More people means more demand for meat, fish.
Which naturally drives the need for productivity, disease prevention, food safety, and livestock. Makes sense.
The memo projects a 14% increase in livestock and fish production just between 2020 and 2030.
So there's growth in that market, too. The farm animal healthcare side is forecasted about 7.5% annual growth through 2029.
But that shift towards companion animals, the analysis argues it's more than just numbers. It's a qualitative improvement.
How so?
It makes their earnings less cyclical, more predictable, more resilient, compared to the livestock market, which can be more up and down.
Oh, okay. Predictability. That leads us nicely into the idea of their competitive fortress or their economic moat. What protects them?
Right, the moat. This analysis pins the primary source on intangible assets.
Which basically means their R&D, their patents.
Exactly. Their R&D engine is described as a powerhouse. The memo says over $650 million invested just in 2024.
Wow. And that generates results.
Apparently so. Over 2,000 new products or innovations launched in 12 years. That leads to a big IP portfolio patented high-margin drugs. They name examples like Apoquel, Simparica Trio, Librela.
Blockbusters, essentially.
Yeah.
And the memo mentions something about durability, how long these products last in the market.
Yeah, this was striking. The average market life for their top products is stated as around 30 years. That's a long time.
30 years. Plus, you have the brand itself, right? Trusted name.
Absolutely. And that intangible strength is reinforced by another moat source. High switching costs.
Especially for the vets, I imagine.
Precisely. Vets train on these specific products, they trust them, they build their clinic protocols around them. Switching means uncertainty, maybe even risk to their reputation if something goes wrong.
So Zoetis works to strengthen that lock-in.
Looks like it. The analysis mentions expanding into diagnostics. The Abaxis acquisition in 2018 is cited and practice management software. They're embedding themselves deeper and deeper into the vet's workflow.
Making it harder and harder to swap them out. Okay, got it.
The memo gives a really good example of this moat in action. Their pricing power with Apoquel, the dog dermatology drug.
Oh, yeah. What's the story there?
Zoetis basically created that market, according to this analysis, took it from maybe $70 million to over $1.5 billion.
Whoa. That's dominance. And they can charge premium prices.
Seems so. The analysis includes some Scuttlebutt direct quotes from vet techs.
Ah, the ground level view. What did they say?
Things like pricing is getting ridiculous and it's at a premium price, so there's friction, but vets are still using it.
Because it works. And there aren't easy alternatives they trust as much. That's the moat right there.
Exactly. And the analysis concludes this moat isn't just static, it's widening.
Widening, why?
Scale-driven R&D advantage, basically. They can outspend competitors. Consistent market share gains growing faster than the market for a decade. That 9% organic growth in Q1 2025, even after selling off a business unit.
That's strong. And the integration piece, diagnostics, data.
Yeah, that further entrenches them. Plus, this concept of life cycle innovation is highlighted as key.
Life cycle innovation. What's that?
It's not just about one patent. It's building a whole platform around a successful drug or area like dermatology or fleetic control, extending the life of the whole franchise.
So like new formulations, Apoquel chewable is mentioned, or expanding labels like Simparica Trio covering more parasites.
Exactly. The analysis argues this makes the whole portfolio way more durable than just worrying about single patent cliffs expiring. It's a systematic approach.
Interesting. Maximizing the value over a much longer time.
Okay. Now, this memo also includes Scuttlebutt, right? Feedback from customers, employees.
Yes, and this is where things get, well, complicated. The analysis calls it a troubling dichotomy in customer feedback.
Uh-oh. Dichotomy how?
On the one hand, some products get rave reviews, like Pet Tab's Vitamins 4.8 stars on Amazon, people praising effectiveness, value, good stuff.
Okay. But the other hand?
Widespread frustration with their Zoetis Pet Care Rewards program. The memo uses pretty strong language from users. Complete ripoff, scam, total letdown.
Oof. What were the complaints? Receipts getting rejected, customer service being unresponsive, just general hassle and a feeling it wasn't delivering value.
That sounds like a real friction point.
And then, maybe more concerning, the analysis flags anecdotal reports and Better Business Bureau complaints about serious adverse events, even death, potentially linked to their new OA pain drugs, Librela, and Silencia.
Seriously, what kind of events?
Things like renal failure, loss of mobility. The memo notes these are anecdotal, but also mentions a formal FDA warning letter about Librela.
Wow, okay, that's alarming. Even if anecdotal, it's a worry.
It is, and the analysis points out the conflict here. Management talks about customer obsession, an exceptional experience.
But this feedback suggests a gap between that strategy and the actual execution on the ground, especially the rewards program mess and these safety concerns. That's a definite weakness highlighted here.
Yeah. And the employee perspective, also described as a mixed bag.
So not all sunshine and roses internally either.
Seems not. Some praise the culture, the benefits company, who cares, but others. They mention a toxic culture, politics feeling like a number.
Any specifics?
The analysis mentions an observed cultural divide between, say, production facilities and the research departments.
Okay, so strong business fundamentals, strong moat. But potential issues with customer experience execution and maybe some internal culture stuff. That's the picture from the Scuttlebutt.
Pretty much. Now let's shift to management and the financials. How does the analysis view leadership?
Pretty positively, actually. Described as rational, owner-oriented.
CEO Kristen Peck gets mentioned specifically. Long history with the company, right? Back to the Pfizer days, the IPO in 2013.
Yeah, the memo suggests she has a deep understanding, a clear philosophy focused on long-term value.
It mentions her purpose-driven mission, nurture the world and humankind, but also a very straightforward shareholder value proposition.
Which is?
Grow revenue faster than the market, grow adjusted net income even faster than revenue, and return all the excess capital to shareholders. Simple, clear.
And does their capital allocation reflect that? The analysis calls it a rational capital allocation track record.
Seems so. Priority 1, reinvest in the core. We saw the R&D spending growth, $500 plus to $650 plus capital spending on manufacturing.
Makes sense. Feed the golden goose. Priority 2.
Value-adding acquisitions, usually bolt-ons like Abaxis for diagnostics, Pharmac, and aquaculture. They also note the discipline to sell assets, like that MFA portfolio divestiture, to focus capital.
Okay, smart M&A. And priority 3.
Returning cash to owners. Dividends have grown fast, 20% CAGR over 5 years, according to the memo. And big share buybacks, a new $6 billion authorization after a $3.5 billion one. They returned $1.8 billion just in 2023.
So reinvest, acquire smartly, return the rest. Sounds like a solid playbook. And this translates into strong financials. Memo uses the term financial fortress.
Yeah, the numbers look pretty robust based on this analysis. Consistent earnings growth, net income from $1.4 billion in 2018 up to around $2.5 billion in 2024, operating margins expanding.
High predictability score too, you mentioned. 4 out of 5 stars.
Right. And the quality ratios are described as, well, elite. return on invested capital, ROIC.
That's a key one. How does it look?
Steadily improving, hitting 22.8% on a trailing 12-month basis. The memo notes that consistently staying above 20% is pretty rare and signals a strong competitive edge.
Definitely. What about cash flow? Are the earnings real?
Strong free cash flow conversion over 92% in 2024, and a healthy FCF margin around 24.6%. So yes, the cash flow seems to back up the profits.
And the balance sheet, debt levels.
Described as prudent, resilient, net debt to EBITDA is low, 1.4x TTM. They've apparently kept leverage below 1.5x for years, even though their public target allows for higher. Shows conservatism.
Good discipline. High interest coverage, low bankruptcy risk scores mentioned too.
Yeah, interest coverage at 15.5x. Altman Z-score at 7.5, both indicating very low financial distress risk, according to this analysis.
Okay, so the picture painted is high-quality business, strong moat, solid financials, rational management.
No.
But the price, is it expensive?
The valuation question. The analysis tackles this next. Is it a fair price now or mid-June 2025 when this was written?
And how does it compare historically?
Well, the current PE ratio mentioned is around 29.5x, the 5-year average, closer to 39.3x.
Quite a bit lower. What about price to free cash flow?
Similar story, around 32.6x currently versus a 5-year average of about 47.8x. So a noticeable discount compared to its own history.
So the analysis doesn't call it cheap then?
No, not statistically cheap in an absolute sense. The judgment is more nuanced, demanding yes, but ultimately a fair entry point for a long-term owner.
So buying quality at a reasonable price relative to its own range, rather than buying a bargain bin stock.
Exactly. It's about acquiring a superior compounder when it's temporarily out of favor, maybe.
And the analysis explains why it might be out of favor. Attributes the lower multiple to specific things.
Yeah, it's like temporary concerns, some weakness in China, the earnings dilution from selling that MFA business, and those negative headlines around Librela. The argument is these don't permanently break the long-term story.
Okay, interesting perspective. So looking forward, where does this analysis see the growth coming from?
Primarily, continued innovation and market penetration in companion animal care. That's the main engine.
Driven by those blockbuster franchises we talked about.
Right. 3 key ones are highlighted. First, Parasiticides, the Simparica line. Strong growth noted in Q1 2025, driven by those combo products hitting multiple threats.
Okay.
Second, Dermatology, Apocal, and Cytopoint. Still solid growth, and the analysis emphasizes the huge untapped market. Says 20 million dogs still aren't treated for itch.
Wow, massive potential there. And the third?
The new osteoarthritis pain franchise, Librela and Silencia. Strong growth again in Q1, and again, a huge untapped market. Over 17 million dogs just in the U.S. with OA.
So the argument is these big franchises can keep driving growth faster than the overall market rate of, say, 5-6%.
That's the core growth thesis presented here. But of course, the analysis also flags risks, things that could permanently damage the business.
Always important to consider the downside. What are the big ones?
Risk number 1, disruption of the vet channel. What if things shift massively online, direct to consumer? Or generics really intensify and erode pricing that could bypass the vets Zoetis relies on?
A fundamental shift in the distribution model.
Okay.
Risk 2.
A major product safety event. This circles back to those Librela Silencia reports and the FDA warning if a big product caused widespread harm.
The fallout could be massive. Regulation, lawsuits, brand damage. Yeah, that's a big one.
Definitely. And risk 3, failure of the R&D pipeline. If they stop producing the next generation of hits to replace older drugs as patents eventually expire,
then growth slows to just market rates, and that premium valuation probably wouldn't hold up. R&D execution is critical.
Absolutely. So growth potential, but real risks too. This leads the analysis into some second-level thinking, a contrarian take.
Oh, what's the market consensus view it's challenging?
The consensus seems to be great company, blue chip quality, but maybe fully valued, with near-term issues capping the stock price. Analysts rated it strong buy, but saw only modest upside soon.
Okay, sounds reasonable. What's the source's contrarian angle?
It argues the market is underestimating the durability of Zoetis' innovation platform.
The platform, not just individual drugs.
Exactly. The market focuses too much on specific patent cliffs, like when Apocal's main patent expires.
Whereas this analysis sees it differently.
Yes. It views Zoetis as owning durable franchises, dermatology, parasiticides, pain. The original drug is just the start, that life cycle innovation we discussed.
The new formulations, expanded uses, follow-ons.
Right. The analysis sees that as a systematic, lower-risk way to extend the franchise's value for potentially decades. It makes the earnings stream more resilient, more like an annuity.
So the market worries about the Epiquel cliff. But this view says Zoetis is already building the next thing within that dermatology franchise, lessening the impact of any single patent loss.
That's the argument, and this provides a margin of safety in the long-term growth outlook that the consensus might be missing. A belief in the enduring power of the platform, not just the product.
Interesting. A different way to frame the innovation aspect. Okay, so let's try to synthesize this. The bull case from this memo.
Based on the source, irreplaceable asset in great markets. Pets, protein, widening moat, R&D scale, vets, elite financials and capital allocation, and importantly, a fair price for that quality given the discount to its history due to temporary issues.
And the bear case, the counter-arguments highlighted.
Potential peak margins, rising competition. That customer friction is a big one. The rewards program, the safety concerns creating brand risk. The valuation, while fairer, still demands strong execution. And the underlying risk to that core vet channel.
So we've really unpacked this one analysis of the business, moat, management, financials, scuttlebutt, risks, valuation context.
Yeah, it paints a picture of undeniable strengths, right? The moat, the financials, the market trends. The management approach seems solid according to the source.
But also clear challenges. That gap between strategy and execution seen in the customer feedback, those safety questions. There's significant flags raised in this memo.
Exactly. Which brings us to a final thought. Something this analysis poses as a red team challenge, a way to really push back on the positive view.
Okay, what's the challenge?
Is Zoetis' focus on life cycle innovation, extending existing franchises, truly a sign of a powerful compounding platform making earnings super resilient?
Or could it be more of a defensive move? Maybe indicating a core R&D pipeline that's maturing, struggling to produce the next truly massive novel breakthrough.
Right. If it's the latter, could that leave them more vulnerable down the road? Could the moat erode faster than expected if a competitor comes up with something truly revolutionary, making one of their big franchises suddenly less relevant?
That's a good question. Is the innovation engine creating the future or just expertly managing the past and present? It really makes you think about the source of future growth.
Definitely something to mull over based on this deep dive into the analysis. Thanks for joining us.